Hi, welcome to our show today. Folks, today we're going to be talking about bonds, right? Fixed income accounts. We're going to be talking about annuities, right? You hear those ads, I hate annuities, here's the 10 reasons why, right? But they're actually very different. And then I want to talk to you about put options, all right? This is a way that you can maybe bet on the market going down without having to risk a whole lot. So stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome back. In this segment, I want to talk to you about bonds, or what we call fixed income instruments or financial instruments. Listen, there's all kinds of bonds. There's what they call government bonds. Government bonds are simply bonds that are backed by some kind of governmental unit, whether that be a municipality, a state, federal government. Okay? Now, bonds can also be corporate, or what we call private. These are bonds held by that corporations issue. Okay? Bonds, for the most part, are debt instruments. Okay? They're backed by the full faith credit of the person that issued the bonds. So if you're getting a corporate bond, it's simply backed by that corporation. Now, most generally in the financial world, bonds are considered safer than stocks. And here's why. Because it's a debt instrument, it actually in a case that company was going bad or went in default, bonds get paid before shareholders get paid or stocks get paid. So, and in case of a governmental unit, they can tax the people to pay that bond. So for all practical purposes, for the most part, bonds are usually considered a lot safer than stocks because they get paid off first in the event anything goes wrong. So credit qualityness is going to be a very important factor. It used to be said that municipality bonds were were all safe. Because they could be backed up by the municipality. But now we're seeing municipalities file bankruptcies. So, are they all that safe necessarily? So credit qualityness is going to be a huge, huge factor, especially when it comes to corporate bonds. How solvent is that company? How good is its ability to be able to pay that bond back? Well, that can be measured. We can do that through an analysis to see, how those rate. You have to understand too, bonds are interest rate sensitive. When rates are rising, bond values can go down. You say, well, how does that work? Well, let's just say I'm holding a bond today that's paying, let's say 3%. But tomorrow, because the interest rates rose, interest rates went up to 4%. Now I can get a bond paying 4%. Who wants my bond paying 3%? So they're going to adjust the value of that bond accordingly for all the lost interest that I'm not going to be able to get with that bond. So as interest rates rise, bond values can go down. Now, the taxability of bonds is a huge thing as well. If you're in a federally government-backed bond, it's usually going to be state tax exempt. If you're in a municipal bond, state bond, it could both be federal and state exempt in some cases. So there's a lot that happens with bonds. I hope this was valuable. But if anything, if you've got a strong bond portfolio and you want to just see how it stacks up as far as credit quality and this and that, then certainly give us a call. You go back 40 years ago, you get the early 80s, and interest rates on bonds were double digits. I think got up 15, 16%. And where are we at today, right? 1-2%. So, we've been in this declining interest rate market for 40 years. But now, I have to say, interest rates are at rock bottom levels, and from here, we can only assume that they're going to go up. So I want to encourage clients, if they're out there and they have fixed income portfolios or bonds, we have the ability, right, to do some analysis, and there's some things we want to look at when we're looking at those bonds.
Absolutely, Larry. We want to get into seeing what the credit qualityness of them, what the duration is, how long are you going to hold those things. I think of bonds, think of like the carpenter, he's got this toolbox and all these different tools that he can access. A bond is a tool to an advisor or an investor that they can go in and build a portfolio with. The reason why people are in bonds is because they want the safety and the interest out of that, and that's a necessary thing in a retirement portfolio, right? But when you're faced with these challenges that we are today with low interest rates, maybe a rising interest rate down the road, boy, what are other things that we want to look at? This is stuff that we get deep into with a visit with you. Looking at a second opinion of those bonds, as Larry's talked about, getting into seeing what you have. What are you making off those? Why are you holding those? And also, is that the best thing for you to be in right now? Maybe it is, maybe it isn't. But also, why do you have those? And why and how do those match up to your goals that you have for your retirement plan? Give us a call at the number on the screen. We'd love to sit down for a no cost, no obligation, second opinion visit with you. We can do that either in person, over the phone, or through like a webinar type thing. Thanks again. Stay with us for the next segment.
Take back control of your financial future. Learn the 3 things you can do now. The mastery of money is a skill that can be learned. Don't leave your financial future to blind chance. Be informed and make educated financial decisions. At Centennial Wealth Advisory, we specialize in retirement planning, helping people just like you plan to retire well. We are known for our informative and educational live events throughout northern Michigan. If you are within 5 to 10 years from retirement or already retired, we invite you to attend our complimentary webinar on Tuesday, December 8th at 6 o'clock. You'll be able to attend from the comfort of your home, right on your computer or smart device. Learn the 3 things of how to take back control of your financial future. To register, call 888-608-5825 or visit cen-wealth.com and click on Attend an Event. There is no cost and no obligation. Don't miss this important webinar and learn the 3 things of how to take back control of your financial future. Again, call 888-608-5825 today.
Through the school programs in our local school district, kids receive physical therapy to work on their mobility skills, occupational therapy to work on their fine motor and handwriting skills, as well as speech therapy to work on their communication skills. And during the summer months, there's limited school therapy available, and the children are selected based on their severity of need. So there are a lot of children with maybe some more mild diagnoses that don't qualify for school therapy in the summer. Due to the limited therapist availability and insurance restrictions, and also the high out-of-pocket costs, Kids on the Go provides programming for the children that don't qualify for school therapy and also might not be able to afford or gain availability to outpatient therapy. So it helps provide services similar to what they'd receive in school, only it's in a group summer camp setting. Kids on the Go is the first of its kind in the entire northern Michigan region, and we're excited to expand our healthcare resources. Kids on the Go is 100% donation-based, and 100% of the funding received for our Traverse City program goes towards supporting local children. And our program is run by local physical therapists, speech therapists, and occupational therapists in our region, and it's based in a local school right here in Traverse City. Kids on the Go is rewarding in that it helps us watch children progress and develop their skills over the summer. And to me personally, it's so inspiring to see them making progress with their mobility skills, their communication and speech skills, and being able to perform some functional things that they might not have been able to do in the past. We're just beginning our journey with Kids on the Go, but I have big dreams for this program. We're starting out small, and right now we have limited days that we're providing these services, but in the future I would love to include a greater age range of children in our programs and different types of programming. Maybe reaching out to different sports-specific programs like basketball, bike riding, swimming, different social skill groups for kids, hiking groups, sailing groups, and things that are really specific to our northern Michigan community here that children can take part in and work together as a team. Well, we're very excited for any support from our local community, and we're thrilled to already have received a lot of generous support from different businesses and individuals in our community that have embraced our program. And we're excited for others to help join us and help build this amazing opportunity for children and families and help these kids achieve their goals and continue to make progress with their physical skills. Kids on the Go has a website, and that's www.kidsonthegocamptc.com. And all camp information and donations can be made through our website. Our camp registration opens January of each year online, and you can simply go to our website and log in there to register, or feel free to email myself or one of the other therapists if you have any specific questions about our programming. As a small and new nonprofit, we were able to pivot and move our services to an online platform where we were able to provide fun and safe therapy to a group of local children. I feel that it was really well received. I had a lot of positive comments from families that really enjoyed working together as a group from a virtual platform. And it also gave our therapists the tools to be able to work together and plan programming that we'll be able to build off of in future years.
We here at Centennial Wealth Advisory realize that everyone has been affected by this coronavirus in one way or another. We watch our retirement accounts drop significantly in value, and we have questions. Can I retire in a recession? How will the coronavirus affect my retirement? How do I develop an income stream in a recession? Can I still retire this year? If these are concerns of yours, contact us today for a free initial consultation and learn what you can do now to help you weather the storm. Simply call 888-608-5825 or visit sunwealth.com and let us help you plan to retire well. Hi, welcome back. Listen, in this segment, I want to talk to you about annuities. Now, anytime we're talking about annuities, we're talking about insurance products, because annuities are financial instruments that are usually involving an insurance company. So very important to understand. Now, a lot of people see a lot of what I would call negative press on annuities. They see the ads that say, I hate annuities and here's 10 reasons why. The truth about annuities is there's a lot of different kinds of annuities. They're very complex. So depending on what your needs are, they can be good, but they can be bad. It really just depends on your circumstances. The one I can think of right off the bat is what they call an immediate annuity. Okay, an immediate annuity is a lump sum the insurance company is going to hold. It's this lump sum of assets, and then they're going to give you a guaranteed lifetime payout for the rest of your life. Guaranteed lifetime payout sounds really great, right? But here's the drawback. If you should pass away, guess who keeps the rest of the money? The insurance company. Doesn't sound very attractive. But if I'm somebody who doesn't care about leaving anything behind, maybe so. Another kind of annuity is what they call a variable annuity. A variable annuity, kind of looks like mutual funds in a sense. They call them sub-accounts, but they're with the insurance company. So it can hold investment risk. It can actually go down in value. But a variable annuity will have another side to it where they give you guaranteed income for the rest of your life, just like the immediate annuity. Now the difference in this case is if you passed away, there's some account value left. The insurance company just doesn't keep the rest of it. But that's going to be dependent on how the market is done if it hadn't taken too much investment risk while you were in it. Could be a plus though if you're looking at it from the guaranteed income standpoint. Another kind of annuity would be a fixed annuity. That kind of looks like a long-term CD. It might be 3, 5, 7 years in length. You can't lose your principal. They'll guarantee that, but they'll give you a fixed interest rate. Okay, very much like a CD does. That can be good, but maybe if the interest rates are low, maybe bad. Now, there's also what they call fixed indexed annuities. They're fixed in the sense that you can't lose the value, okay, that's a good thing. But instead of giving you a guaranteed interest rate like a fixed annuity does, they'll tie it to some kind of an index, maybe like the S&P 500, maybe it's gold. All right, so you get to participate in that index if it's up to some level or degree, but you don't have to participate in the down. Folks, there's so many features that comes with these annuities, and so many times people have these financial instruments, they don't understand them. I encourage you, give us a call if you're somebody that has any kind of instruments like this and you just want somebody to explain it to you. In many cases, you might find it's perfectly appropriate for you under your situation, but maybe in some cases you might find it's not. Now, a lot of problems with these annuities sometimes is the holding period. So, you may not be able to get out of it right away, but at least understanding the features and what you have might be very helpful. So again, give us a call.
Larry, thank you for doing this segment. I have to imagine annuities are potentially one of the most misunderstood financial instruments out there. I think of these, people hear the word annuity and I think some people cringe and some people look to maybe learn some more. I think it's probably like me when I hear extended car warranty. Like I just want to not hear any more about it because I've had a bad experience with it. With annuities, as you've just learned, there's so many different pieces of it and you have to understand what they are. It's just like with any investment or you get put with something that doesn't match up, you're probably going to be disappointed. But when put in place properly, it can be a very valuable resource or tool for you in your investment plan. They can do things differently than some investments, and they do things similarly in some investments. But boy, what a powerful thing that you can do for your retirement portfolio. But it's really important. There are so many different kinds out there that you have to know what you're getting into.
Yeah, Art, we talked in the first segment about bonds and how, there's just such a low yield on them anymore. I mean, when people were working, they're in the growth and accumulation phase of their life, they're predominantly in equities. And then as they get close to retirement or in retirement, they would usually transition over into fixed income accounts or bonds. But when they were yielding a lot more, today they can't get that income they need. So, again, going back now and looking at these annuities, in some cases, they could act as a bond alternative. Take a fixed annuity, for example, giving you just a guaranteed interest rate. Now, that interest rate's traditionally a little bit better than what they can get maybe on a yield on a bond. Maybe an idea. Maybe a fixed index annuity where they have principal protection, you have the safety that you have with a bond, but a little more potential for upside if the market cooperates or that index cooperates with it. So, folks, these are complex financial instruments. A lot of you have these out there. You don't really know what you have. You heard words like guarantee, but you want to understand what that guarantee is. I encourage you, if you're somebody who wants to learn more about those financial instruments or have some yourself and just want to know more, certainly give us a call. We'd be glad to meet with you. Take back control of your financial future. Learn the 3 things you can do now. The mastery of money is a skill that can be learned. Don't leave your financial future to blind chance. Be informed and make educated financial decisions. At Centennial Wealth Advisory, we specialize in retirement planning, helping people just like you plan to retire well. We are known for our informative and educational live events throughout northern Michigan. If you are within 5 to 10 years from retirement or already retired, we invite you to attend our complimentary webinar on Tuesday, December 8th at 6 o'clock. You'll be able to attend from the comfort of your home, right on your computer or smart device. Learn the 3 things of how to take back control of your financial future. To register, call 888-608-5825 or visit cen-wealth.com and click on Attend an Event. There is no cost and no obligation. Don't miss this important webinar and learn the 3 things of how to take back control of your financial future. Again, call 888-608-5825 today.
Every night around the table after grace, we all hold hands, and the child of the day that has done something kind gets to go and say family, and then we all follow through and say always and forever, no matter what, and then we squeeze hands.
What qualifies someone to be a foster parent is simply if they can love a child. What Bethany Christian Services is to Michelle and I is a lot of different things. Kids don't come with a rule book, and foster parenting definitely doesn't come with a rule book, even though there's licensing and stuff that goes along with it. But what they are to us is a resource. And no matter what questions we have, it's an easy phone call to make, it's an easy email to make, and within minutes, if not the very next day, they're back in touch with us with an answer, a solution, or a helpful hint to try different things.
Hope keeps us going, but love is the reason.
Bethany Christian Services is a global nonprofit that supports children and families with world-class social services, all designed to help families thrive.
They love children. They love God. They know that they want to spread that love throughout the world and help those vulnerable children.
Love is not always easy in some situations, but you kind of let your barriers down, you let your guards down. When you see children in this tough situations they're in, you kind of throw caution to the wind and don't think about the consequences. You don't think about the what ifs, and you just say, if I have a few days that fall with these children, maybe I can change their lives.
Fostering has taught us to be flexible, to have more faith, and let go and let God.
I want to help you. I want to give you some love. Come here, I want to give you a hug if that's okay. That's what qualifies someone to be a foster parent. You don't need to have all the answers, because nobody does. You don't need to have all the training down pat, because you can't. You learn as you go. But if you're willing and you have that love, that's what makes a good foster parent.
If you see a 2-year-old kid come into your home that's never had love, it will change your life forever.
It means that if you're sitting at our table, I don't care if you are a foster child, if you are a biological child, if you're adopted, if you're off the street, your family, always and forever in our house.
Hi, in this segment I want to talk to you about put options, okay? Now options it can be very complex. A lot of people don't understand what they are, so I thought I'd take some time and basically educate you on how they work. So when you buy a put option, you're buying a right to sell a stock at a certain price, okay? You're thinking that the price of the stock is going to actually go down. All right, so what you want to do is buy a right to sell it at a certain price so that if it does go down, you're going to make money. So you can do what's called a long put, okay, meaning you can speculate on that down and buy that right, or you can hedge a position that you already have. Let's say you have that stock and you want to protect yourself on the downside to sell that stock, then you might want to use a put. Okay, you know, when you're hedging a position, liken it to like a farmer. Okay, he plants his crop today. He wants to protect the price of that crop so that by the time harvest time comes, he can sell at a certain price. So he buys a option or put on the market, right, to sell at a certain price, or what we would call a strike price. Okay, so he plants his crop. Harvest time comes. If the price of the market happens to be up, or that crop happens to be way up, well, no harm done, right? He gets to sell it at the higher price, less the cost of what he paid for that option. But what if the price happens to be down at that time, right? Now he's glad he bought the insurance because he gets to sell it at that price. Folks, that's what you call a protective put, all right? You're just basically hedging a position that you already had. So let me just kind of follow you how this might work. This is a ABC stock. Right now that stock is selling at $100. $100 a share. So I'm guessing that the price of the stock is going to go down. So I'm going to buy a put on this stock with a strike price of $95 in 1 month. Okay, so I'm betting that the price of the stock in 1 month is going to be down lower than $95 a share. Now, the price of that trade is $3. Okay, now the price of trades vary on the stock price, the volatility of that stock, and how much time it's got to expire. So in this particular case, with ABC stock, the trade price for this put is $3. Okay, so where's my break even? Okay, my break even is going to be $92, which is the strike price less that trade fee, right? So if the price of the stock goes below $92, I'm in what they call the money. All right, and I can make money all the way down to zero. So I have a maximum profit that I can make of $92, right? But where am I not going to make money? If the price of the stock is anywhere from 95 or up, right, I'm not going to make any money because I was betting on the down. But my maximum loss in this particular case is only the $3 I paid for the trade. So, I've hedged my position. I've bet $3 that the market go down. It doesn't go down. I'm only out the $3. But if I'm right, look at the maximum gain I could potentially have. So hopefully that maybe gave you a little better understanding of how puts work. They can be beneficial if you want to, bet on a stock's direction and don't want to risk a lot of money.
Boy, Larry, you're keeping everybody on their toes this week, aren't you? You just come off insurance and annuities, now into puts here with options. I hope you found that really interesting and educational, because that's obviously, very complex investment options and lots of pieces to that. What's interesting is in the early part of the show today, we talked about annuities and various types of that. When they offer a lot of these guarantees behind the scenes that you're not seeing as an investor, a lot of times they're using those options to be able to generate those interests, generate those guarantees that they're offering you. So there's a lot of that going on behind the scenes in various investments that you may never know of or necessarily don't care to know about, as long as you're getting what you were told you were getting. But that's how they can do a lot of that stuff, right?
Yeah. Or, it's that story I was talking about, the farmer who planted the crop. Well, what the annuity company is doing, or insurance company, is they're saying, okay, we've got to protect the principal for this next year for this client because we were contractually obligated to do so. So we're just going to buy a put on the market, right? They're basically buying insurance to protect the principal from the year to the year. So, they're going to spend so much of their money on puts or options to kind of protect principal. The rest of it's going to be predominantly in government securities, right, to keep it safe. So, but I wanted people to understand puts because you hear a lot about it, but it seems so complex. People don't want to get involved in them. But if you caught anything in that segment, if you want to bet one way or the other, when you buy a put, your maximum loss is what you paid for the put, right? So if you want to minimize your losses and maybe bet on a direction, that might be one way to go. Now, just curious, if you're trying to find out what the prices of some of these are, you can go into most browsers where they have stock quotes, and they'll have an option section, and you can pick any stock and then actually see what those option prices are. It may or may not be for you. If it's something you want to learn more about, give us a call. We'll gladly kind of educate you, show you kind of how they work, and if it might be a right fit for you. So anyway, thank you for joining us this week. We'll see you next week.